Morning traders, welcome to the Traders Lab. Having a little technical difficulty in Discord. Are you guys able to hear me in YouTube? Okay, great. Having a problem in the Bookmap Discord Trader Lab. I'm not able to get connected to it properly. All right, well, good morning, everyone. Sorry about that. If you're in Trader Lab, you might want to switch over. Let's see. Check. All right, looks like I have audio now. All right, thanks, Stephen. I'm still having just got to switch around here a little bit, a couple things. Okay, how we doing in Discord? Do you have display? Yeah, thanks, Dan. All right, are we okay here now? We'll move forward? All right, thank you, everyone. Thanks, Dan. Thanks, Stephen. All right, good morning, everyone. Apologies for the delay. This is Trader Lab. This stream's about integrating Bookmap Orderflow tools with auction market theory using a volume profile in the intraday developing time frame. It's based on structured trades that are available to all of you, and the Trader Lab is available at no cost. Trader Lab's about the business of trading, understanding this is a business of statistical probabilities or edge and not a video game. And Trader Lab is really for serious traders, those who want to establish or create the potential for a career path, and also acknowledge that this is not a quick fix. There is no such thing in this business, because we have to push back not only against our, call it human nature for fight, flight, fear, managing fear, looking for certainty and confirmation. All that terminology reflects your psychological or subliminal primal needs. Doesn't exist in the business. Most of us, when we initially come into the business, are looking to fulfill those needs. However, this isn't the business to give you those needs fulfilled. We try to bend the business into something that's psychologically comfortable, when the actual fact of the business is you're completely uncomfortable 100% of the time, because of the random distribution of outcomes, not the overall outcome. If you actually have statistical probabilities and the discipline to execute, same as the casinos or gaming theory, but your nature is going to be to try to bend this to your comfort. Doesn't exist, you won't be comfortable. So how do you get comfortable with discomfort? Interesting question. That's statistical probabilities and developing the discipline to overcome your fear. Interesting concept. Well, most of the marketers and influencers that you're going to run into and the gurus are going to show you and tell you about the only one thing you need. Well, you've been doing that. You already know that's not the thing you need. Maybe you need something else. Maybe instead of having a marketer feed your need for certainty, which of course you're going to bite on, maybe the thing to do is understand that you can't get it. So let's try to bend you a little bit into operating with uncertainty. You have to change yourself, not try to change this business to something you're comfortable with. Again, that's just an opinion, but it's also 46 years of experience. And come to Trader Lab, there's a lot of experience there, a lot of time in, and traders just like you and me who have gone down the same paths. General disclosure, all Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice or recommendations. Risk disclosure, trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please remember, this is not a trade calling room. This is for educational purposes only. Very quickly, this is really how the market works. It's an auction. It's always going to try to figure out what's too high, what's too low, and what's fair. And this is what creates our rotations. The process or the chassis to overlay potential trades onto something called a volume profile. Volume profile is nothing more than a representation of you shopping in the store. The difference is the S&P store or any market store or auction process is related to the rotations that you determine to trade. This is where we get into this conversation of higher time frame might be up, shorter time frames might be down, and intraday it can be both and will be because the market's continually changing depending on the time frame. Think of it like Russian dolls. This is a very simple idea. Multiple time frames is a vertical integration of different rotations. So the higher time frame, as an example, now might be a bull market. In an intermediate time frame, it might be time to be short. Intraday time frame, it can be long and short. Right? What is the answer? This is a confusing question for you, but the answer lies in your trade plan, not in flipping and flopping playing a video game. Now, you can do that, and you're going to have winning trades, but I can suggest, based on at least what I've observed over the years I've been in the business, both professionally and now out here with you, that's not sustainable. But it is a good time. I would say if you're going to gamble, accept that you're going for entertainment, get the cocktails and the ticket to the buffet. Might be more fun. Context is the condition of the market, and this is the more complex parts of this, because when you have multiple time frames, if we think we're in a higher time frame bull market, and I'm not saying we aren't, I'm just saying we're in a market, but let's assume it might be bullish until it isn't, depending again on time frame. How do you integrate a bull market and then maybe you're short? How do you deal with that conflict? Well, there's ways to sort that out, but you have to know where you're trading and the rotations you're trading or the range you are trading, and try to overlay that in this vertical integration of time frames. And I always think of it like Russian dolls. If you want to think of that, Matryoshka dolls that are inside each other. That is really what multiple time frame is. Now, the other thing about time frame is in the developing daily time frame, there really isn't time. There is participant behavior. So the clock doesn't regulate it. It's regulated by the buyers and the sellers. It's a different way to look at it. So we're not trying to put the market in a box. What we're trying to do is align with the market. It's a much different way. So alignment, we can use the volume profile for alignment, and then we can use Bookmap to help us see inside the participant behavior for triggering, interacting with the icebergs and the resting liquidity and the rest of it. So we're going down into, I call what is the tip of the spear. This is the process. And then if you visited Trader Lab, you know that there's a library of webinars, some up to 4.5 hours long of real-time narration, and some examples of the trades that we discuss in the Trader Lab. But you have to reverse engineer everything. In life, there's no plug and play, right? You've already been there and done that. It doesn't exist. Oh, who's that? So let's move forward. And thanks again for visiting Trader Lab, guys. Let me try to get to this. Okay. So RTH open. Now, guys, if you're in Trader Lab again, grab your grid sheets. One of the things I've tried to do and share in Trader Lab, as well as other traders, because this is not about me. This is about every trader who comes to Trader Lab. The goal, what makes Trader Lab what it is, not only, of course, it's no cost. What it is, it's a community of like-minded traders who've come together to leverage their collective experience. We've all walked in your shoes, so let's all get over it. Everybody starts out doing the same thing because we start out trying to fulfill our psychological needs. So when you start out trying to get certainty and confirmation, why wouldn't you? It seems logical, doesn't it? We all start the same way, and we all kind of repeat and walk in the same shoes, and they're derivative shoes. In other words, some of us do this, some of us do a little of that, but in the end, we always end up in the same place. So I'm not saying that's the case for you. I'm just saying the rest of us, So why does that happen? Because we're trying to bend the business to what is logical to us, which is don't step out in front of the bus. Let's avoid that risk. Let's get some certainty, and let's move the ATM in the basement. But for some reason, it doesn't seem to work. So let's grab our grid sheets. Let's take a look at what we got going on here in one moment. So, let me show you one other thing. This is the higher time frame, okay? And this is yesterday's close. Now, this is a intermediate consolidation. And the goal of this day before yesterday, was to come down and fill this gap. This was an open gap, okay? So we got there yesterday, pretty exciting. Day before yesterday. Then yesterday, we took out the stops. Now, something to think about. Now, yesterday, the high of the day, and this is ish, I say ish. There's no precision in trading. So all of you that are, you know, accountants, typically scientists, engineers, dentists, typically have challenges when it comes to trading because they're used to precision. And there's no precision here. There's areas of behavior. And the part of that has to do with momentum. So if you have an area, it's not a brick wall. It's an area of behavior. 6908 quarter for yesterday was an area of high volume. Now, what is high volume? When you shop in the store, high volume is an accepted price. It's called retail. Throw 10 in the cart. All right, I need them. It's a fair price. But if it goes on sale, you're going to throw 20 in the cart. Just saying. But if the price gets too high and you return to a price that is now too high, it was once fair, but now it's too high, and we come back to it, and the shoppers go, I was willing to pay that a couple days ago, but now I'm not paying it. It's too expensive. We can check the price, like in your store, and if it's too high, you leave the store. That's what we did yesterday. We checked too high. Now, the other part of the thrill of this whole thing is the market goes up to go down. The market goes down to go up. It goes up to go down. It goes down to go up. Now, often what happens is, and again, nobody knows, so this is not predictive. If the markets are going to go down, it's going to go up. And now your head is spinning, right? Why? Because there's buy stops here. If I come up, take out the shorts in here, which are buyers, and I come up above the previous day's high, and then I come up to my retail price that's too high. This is the beauty of the auction. Now, you can't predict what it'll do. But if this is too high, I can reject it. So yesterday, on the open, we set up too high. And that set up potential shorts to come back across the range. And then maybe fall out the bottom or whatever it does. And what it did is it went down, and then we had short covering. We came back here. So we were inside of this consolidation, intermediate time frame. And then this morning we gapped out, and we were down in here. And this is done before RTH open. Now we have two possibilities here. Come down here. This is a gap, which whatever it is, I don't remember exactly where this is. I think it's around, I don't know where. Can't see it. And then possibly to come. So 73.75 is an area, and so is this 89.75-ish in here. Okay? So this was the possibility. So on the gap, for me, and resistance was 30, 68.30. So we open under 30, then it's go south. Now let's get our context sheet out. Now again, you may find you're yawning and your head's hitting the desk. The reason I'm doing this is what a trade plan is about. It's not a predictive thing. It's an alignment thing. So our context sheet says the market's opening out of balance. This is balance. What are we doing? We're gapping. We're out of here. Market's out of balance. So now, is the market responsive? Responsive means, do we find buyers down here? Well, initially, no. So it's get aligned with the gap, and as far as we know, it's going south. So that's where we start. So let me see if we're at the RTH open. So let's take a look where we are. Hold on a second. I got to make some adjustments to IRT, get some levels off of here. Some of the levels that are on here, you see those HVNs and things, they're reflecting current, and we don't want current. We want back where we were. 1 second. I'm on a laptop, by the way, guys, so be patient. Kind of lose things here. I'm in Mexico. Hold on. All right. Sorry. Okay. Back. So this is the ETH volume point of control. This is the retail price from the last auction. This is the 68.30. This was a retail price that we gapped under. That can become resistance. We have the overnight mid. We have 45, which is a breakout of the consolidation that I just showed you. We have then, here, let me just go a little further here. Where is yesterday's low? I think we covered it. Guys, yesterday's low, do we have a level for that someplace? 49.5. Okay, very good. Thank you. This is yesterday's low. I'm just going to make a note over here, 49.5. And it's all very important to how today shapes up. Just give me a second to throw that in here. It's actually covered up over here by today's high. Isn't that interesting? But we're going to talk about this because this is really interesting day. And this is going to show you how you can use these tools, Bookmap and structured trades. 49.5, 50. All right. Fine. Let's not get carried away. So first thing is RTH open. This is the retail price, fair price. We're opening below it. We have the ETH low. We have the ETH high. And who knows? So based on the context sheet, what are we anticipating? With this gap, we're out of balance. We're looking for potentially gap and go. That means open lower, get short, push your helmet on, and we'll see you later. So the first trades are shorts. So let me show them to you. Now, these are structured trades, and you have to vet everything for yourself. What that means is there's nothing mechanical in trading, wouldn't we like? What there is alignment. So on the open, it is shorts. So my first trades are shorts. That's all I can tell you. Now, I want you to understand something. Surprise, surprise, we all take stops. And, I'm sure there's many of the gurus out there and Instagram influencers who don't take stops. But unfortunately, I haven't gotten that down yet. So, and I have to tell you, I'm very happy to take a stop when it happens because I'm protecting my account. It's not about being right. It's about alignment and probabilities, not predictability. So we open RTH open, and remember, right now we're gapping, and until proven otherwise, we're out of here. Okay. So this is called developing volume point of control. Okay. And I call them a variable high volume node. All it is RTH open, volume resets to 0. It's a new day, or RTH open. Now this is called the auction. And wherever the volume is taking place and if I leave it, it is suggesting, not predicting, that maybe, by the way, you're always going to hear me say maybe because there's no certainty. So how can I say it's going to when we don't know what it's going to do? So it might do this, it might do that, it might not do any of it. So maybe it'll do this, maybe it'll do that. But here's what I have. I have liquidity coming here. I have resting liquidity here. I have resting liquidity here at a strike price 68. So I'm looking at this and I'm going, well, that's interesting. Let's aim for that. So, but I don't have anything yet. As far as I know, Acapulco cliff dive. So too high, next retail price. What is it telling me? There's more volume here than there. Now I'm going to label it. I just follow process. I don't know anything. What I know is I have a plan, I align, and either it works or I take a stop, I get risk neutral, or I scratch. That's pretty much my thing. So this is a short right here. So I take a short here, I take a stop. Okay. I come across here, I come out to the open above. This is my resistance. I break below it. This is another short for me. and I'm still coming down. I get my scale this time. I'm just telling you, it's nothing special about it. It's just a trade. And now I'm holding because I have this liquidity down here, and that's going to be my next target, theoretically speaking. So small stop, short, scale, hold, next. Okay, so I'm now working towards this. So here, I get my buyers, I see the change, and I'm going, well, as long as I'm back here, I'm under here, and if I can hold the mid in the VWAP, then I have to get below here, and I'm just sitting for this. And it takes off on me. So I get taken out, make a few burgers. Now what? Now I have two locations. Now this is very aggressive buying. So I'm coming up here, and I'm looking at overnight volume point of control. So this is resistance. But this is really strong buying. So I'm a bit perplexed by all this. And I'm just telling you me. So I'm looking at the behavior because this is resistance, because this, we opened below it and it was too high. Well, what happens if this becomes too low, which I don't know until I cross above here. Then it's, and this is kind of like the last stop on the hit parade. So once I'm above all of this, then it's what's going on. Look at the buying. So the meter is going off, So right here, I break above the overnight volume point of control and I hit this liquidity. So I have a couple of issues right here. I have 30 as a key location. And this is really my over under, this 30. Because if we get up in here and I can't get above this, and 30 was the naked volume point of control. It operates very similar to what the overnight volume point of control does. So this is the last auction. It was too high. I break above it. I check it. It's now too low. So then if I get above here, 30 is like the last location. So when it got here, went through it, then that's it. Now it's 45 and up here. So what I did here, right here, once it got away and it's over above 30 and I cleared this, this comes in. I took a long here against this. I didn't take it over here. Could have taken it here, but this liquidity was right here. So that's why I didn't take it. This is a legitimate long here. Here, I did not take it. But this is a long. This is an order flow trigger because we're above the overnight volume point of control. This should be, you guys should screenshot this. And the key with this one, well, either you could buy it right here, if that's your thing, and you have this sweep. So this, and we have an outside edge, LVN. This is a potential long, but the actual long, depending how you want to structure it, is here. Order flow. Because now you already tested this. Resistance, test, break, support, long. I didn't take it. Just telling you. I took this one. Okay. So I'm just telling you, but they're both the same. Does everybody see these? So these are longs. Now, the next thing is, now, the next area is 45. And let me show you where these are coming from. So we had the naked VPOC at 30. So remember, the idea was 30 might be too high. 45 is the breakout of this consolidation. So we could come back and test that, which is 45. If we get inside, we can test yesterday's low. Now, remember, the market was not responsive. What is it doing now? It is responding. Now, if it responds, we have to be looking at what is going on. The market is responsive. So what we have to do is we have to fade the gap back into balance. And we have to watch for a retest of the previous range and the previous value area. So the probabilities of and we opened lower outside of range. The probabilities of testing yesterday's low are 68%, past performance not indicative of future results, to test yesterday's low. To take out today's first hour's high is 65% probability. Getting to the value area low, 45%. And I'll show you what these things are. So once we turned around, then it was longs, longs, longs. And for me, the 30, and there was also the overnight VPOC, which was, an earlier level. So you could have gotten long there, gotten long here. And then you're going for 45, then you're going for yesterday's low, then you're going for value area low if we get in there and higher. Just saying. So now let's come back to the proverbial trading party. So what are these levels? Overnight volume point of control. This is a long. Back to 30, which is resistance. Break high, potential long. Then what are we trying to do? Get to yesterday's low, which is, by the way, over here. And here's the first hour's high with the high probability of taking that out and getting to yesterday's low. Next target. So I'm long and I'm working these targets. I'm okay, fine. This is the next target right ahead of this. And there was liquidity sitting. See this liquidity come in? So it's right at yesterday's low. So for me, if I see liquidity at a price, so do other traders who are using an advanced order flow tool. If that's the case, I'm getting out before yesterday's low. Let somebody else have all the thrill. Then if I get into the range, this is the next key piece. Then it's value area low, which I think is, let me just show you where it is. So that's a sequential target. And remember, why a value area low? If I get inside the range, that's the next location. It's about a 45%. And I have over 90% probability, or specifically 65% probability taking out the first hour's high. So that's at 9:30 Central Time, which hasn't happened yet. So let's go over here and take a look at this thing. And where's that value area low? Hold on a second. Because I had my runner was up at value, here. So 45% probability to go here. So the idea was come up to yesterday's low. And then if I get in the range, go here. Is everybody with me so far? This is very important. How we doing in YouTube? This is very, very important. And here's why. Because in our grid sheet, our context grid sheet, is the market responsive? Yes. What do? We fade the gap back into balance, which you don't know until hindsight that it flipped around. And once it starts taking out structure, you want to be long. Now, the key becomes what happens? We are watching for a bounce or the retest of the previous range, which is here, and the value area, which means get in there. So that's why my longs, my runner, so scaling, and then, because I know if I can't get in the range, then it can set up a short or an exit, one or the other. So, and this was the runner's target, which I thought was pretty good, get 20 points. I'll leave one on for that. Would you? So anyway, got here, and it was at 9:30. This is important. All of this, watch what happens here. Remember, we have a high probability of taking out the first hour's high or low, and we're up here. We're above 30, which was a key location where we had longs, and we also had a long at the overnight VPOC down below. This is a target, that's a target, and this is very important. First hour's high over a, 90% probability to take out first hour's high or low. We're in the squeeze, and we're going to the moon, except 9:30, first hour's high is here, and we have a high probability of taking it out, and then we have these targets. So it's either, and as far as I know at this point, the squeeze shall continue, right? Until it doesn't. Now, the first hour's high is here. This is called the IB, and this is the key piece. We are rejecting the previous range. Now, you don't know this, of course, until hindsight. So when we come inside here, we have two potential trades. We have the IBF, which is a reversion trade, and we can come outside and then come back here. That's one side. So you can come here, here, out here, rotate back here, and continue, or you come inside because we're rejecting this range. And if we reject this, then we can turn around and get short. And it gets right here. It is, you feel lucky, as Dirty Harry used to say. So there's this liquidity, there's location, failure to get into the range. So if we can't get back in the range, then we can sell it. Now, the thing is, how do you know when you're not getting back in the range? Let's take a look. This is key right here. So we come outside. Now, right in here, 30 is the important level. So you have two choices here. You can take a short here for the IBF, and you're going to trade back to the VWAP, and then a potential long outside at an outside edge, or after this test of 30 to come back here. Both trades are legit. The problem, let me tell you the problems. The problem with a long, and you might get here. The problem with the long is we failed to get in the range. And what does our context sheet tell us? We have to fade this. And is the market responsive? Yes, but what happens if we don't get into the previous range? We can no longer fade. We have to trade back in the direction of the imbalance. So, and you're not, for me, it's not clear to me here. It's just, I know it's this or south. And right here is the test of the buyers. So subject to your plan, if you're counter trend, and at the moment, this is the warning Will Robinson moment, you can take the short there and then along to here. So what I did was exit my longs, did not take the short, and then I took this. I took the VWAP and scaled, going for here, going for the IB, going for the value area. And the value area, once again, the value area low is only if we get back in the range. But this, my primary trade for the longs here was risk neutral, reversion, IB, and then one, for the hopper. So I got a scale. I get VPOC migration. This is not good for the longs. And that trade, that was it. Okay. So that's it for me. So now I did not get the short there. So I had the long here, got the scale, was trying to go there. Then everything came off. Actually, I didn't get out of it. Trailing stop took it out. Okay. So here I was still in it because I was trading outside of this LVN. So, but once we're down here, then no good. Okay. So this is okay for me. This, but this is the problem right here. This is called VPOC migration, which is saying that's too high. So that is basically saying, yep, see you later, get short. So if there was any doubt about shorts, it's over here. If not, there. So now it would be shorts only, and you could trade this, from the short side. And then the possibility is to come back down here and maybe get the ETH low. So there's over a 90% probability, about a 98%-ish probability. It's about 90. And you have to bet these to take either ETH high or low. So this is next, not a recommendation. So Now, so you guys understand, my trade plan's not your trade plan. My trade plan is I trade for higher, larger rotations. So I will sit longer, but I also will turn around and sit longer going the other way. So this is where I'm trying to go. Down in here, and maybe even 75, but we'll see about that one. And these are not trade recommendations. I'm going to flip these levels back on. If you guys have questions, drop them in the hopper. We'll see. Okay, I'm losing the chats again. Let's see if we can get them back. Ben is asking, do I always look at microstructure? Yeah, I do. I look at microstructure and I look at retracements primarily to microstructures or reversion to the micros as triggers. I'll give you an example of one, just so you can kind of see what they look like. But that has to be aligned with location, otherwise you're going to see this stuff all over the place. Like here's the high, okay? Notice the liquidity. So this is a piece of information that's important. And this is just an example, okay? Now, when I look at this stuff, I look at these as stores, the shopping experience, and don't forget location. This is a key location. Liquidity is resting in the book, which is why on the longs, the exit was just ahead of this, right in here, and that's lucky also. But I don't put it where everybody else is. If I see liquidity, I know there's sellers waiting there in the limit order book, and I don't mind giving a couple of ticks up to get out of the thing. Not worried about it. There's no precision. Now here's what this looks like. So Ben, this is what a trigger looks like. Now, what is a trigger? I mean, what does it look like in volume in a microstructure? Well, this is your volume. If you look to the right where it says CVP, this is really what the auction looks like. So you have sellers up here. There's your icebergs. Who knows? Resting liquidity, and the buyers are here. You see, you have the red bubble here. And why didn't it go down right there? Because there's absorption. There it is. There's a buyer here on this side buying the market orders, and the sellers are out here selling into the market orders. You need a market order, and there's a passive order. So you always have an aggressor and a passive. You don't have two aggressors meeting. You have aggressor and passive. Icebergs are passive. They're the passive side, and aggressors. When you get a green bubble, just think Pac-Man, and it doesn't go up, that means that there's a seller absorbing. So when you're seeing these aggressive buyers, you need to see the reaction. So what I'm seeing here is aggressive buyers, less aggressors, but higher price, less aggressors. Now I have more aggressors, so okay, higher price, less aggressors, same price, some sellers, support, and and I get a higher price, but what's going on here? Now, nothing, right? So I don't know. Now I see sellers, and my buyers are here because they were there. I break below. So now this is a trigger. Notice the change in delta. That's aggressive. Now I pull back. This is micro mean reversion. This high volume is a retail price. Now let's think about this in what it really is. Shopping. The retail price, think of a mini mart down the street. Sellers are here, buyers are there. The retail price of an S&P in this consolidation is here. And if I break below and I come back and I can't get above it, it sets up a short. You could sell this. That's a trigger. And the way we can see it in the profile is a distribution of volume. If you go to the store even though somebody will pay it, and if you find a price that's too high, you're going to leave the store. So you can use this as trade management. You have a sell trigger. And the reason it's important is where it happens, not that it happens. It's where. And it's because if we can't get in the range, then we're going to go south. And the longs that are in here are now trapped. And then this sets up the opposite, okay? So for me, I saw this and I said, well, I can come back here and revert. And then, either we come back and test or, whatever it does, it does. So anyway, that's the VWAP, the VPOC trade, which is a structured trade. So let me show you the other side of this thing. I'm going to show you the trigger coming the other way. So this is a structured trade, and the idea, it's called a reversion trade, is to come back up here. So we come down, down, down. This is our area. Where's my trigger? Well, what do I see? Microstructure, sellers below, buyers were there. That's resistance. Microstructure here, high volume, break below, resistance is there. Break low, where's my resistance? It's there. Break low, where's my resistance? It's there. See how I'm reading it? Break low, where's my resistance? It's there. There's my support. What am I thinking? Going to zero. What does it do? Break high. Where's my support? There, right there. This is a long. You're going to wait. This is a long, you see, and then you're trying to go north. Where's my support? It's here, here. So you could take long, stop under here, and you got to get above this thing. And so you'd be risk neutral, and you're trying to go here. Okay, so this long, and you could see the trigger, right, Ben? Right idea is the naked volume point of control are high volume areas that are left behind previously. So 30 was an important level. Let me try to do this. That we gapped under. You see the 30? This was a naked volume point of control, and we were below it. So if it's too high, it's resistance. All right. If we get above it, then we have this 45, and then we have yesterday's low. If we get in here, then we get this and this. We reject this, then we get back here, and then everything goes back south of the border. And I can't tell you what it'll do. But we do have the possibility that the longs, the responders in here, if they can't get back into yesterday's range, then the longs who got long this morning, they're on the chopping block. And then you want to be short. Because now they're in trouble, you see? And then we can come down to 73, 75 or not. But that's why you'll see multiple naked VPOCs on here, because their areas of high volume. Now, the fact that there's a naked VPOC there, it's not a wall. It's telling us that it's a level of interest. Now, VWAP to VPOC is a structured trade. Now, I have to always say we have a conflict here because we rejected yesterday's range. And this is where, trading gets kind of murky time frame wise, because rejecting yesterday suggests shorts. But the possibility is that if you don't get the short and you're using it for trade management, you can still look at a long for a reversion trade. But you can't forget that it might not, like any trade, it might not get back there. And you might want to use these rotations to the upside once you are convinced, if there is such a thing, that we're going south, to start shorting. So if you took a long here which is, I don't have a problem with it, to at least come back there, then you can do that, and whatever it does, it does. This changes everything. If you weren't, short, this would get you short. This is a short. And the idea is if we get below this low volume area, then we're rejecting all of this, then we can go south. So that sets up your shorts if you're not short already. And then we're back here, which is not material anymore. We're under the 30. That is material. And then you're looking, come out under here and get to the ETH low, which is the stat. ETH low, well, put it this way. There's a 91% probability to take out ETH high or low. All right. 68% probability to fill the gap, which we did. A 65% probability to take out the first hour's high. We did. There's a 64% probability to take out the first hour's low. To take out the first hour's high and low is about 11%. But we failed to get into yesterday's range. So the statistics are not the priority. The context is the priority. So we're going for this. So you could be short from here or higher up. So the possibilities were take the short or exit the long up here, come out here, then get the stops at the VWAP, get outside and rotate back in reversion, and then possibly come back to the IB. That was my trade. And if not, then turn around and then just go for this. So that's it. You don't have to have a lot of trades. It's really about alignment. And there's traders in TraderLab who got short up here. I'm slower in the sense of I'm going for larger rotations. So I turn slower, just the way I do it, because I just do it that way. So anyway, we're looking, so let's look at this. This is our RTH profiles. Basically what we did is we filled the gap, and then we found our sellers right here. I'm not paying that. Yeah, but it's on sale, retail. And if we leave that, basically, that's your failure. This sets up a potential short, which is fine, or you're letting it come outside to come back here. Either doesn't matter, subject to time frame. For me, it was okay to get over here, to come there. That's all my long was, with one out there just in case we got back. But we didn't do it. So then it's okay, turn it the other way. I call it turning the barge around. So now it's shorts, come out here. And that's not a recommendation, it's just structure. So that's a way to do it. Or you're short from up here. This is a valid trade in TraderLab. And it's because of that. Because in the context sheet, we failed. We tested the range and we failed. So this is a valid trade. It's called the IBF. So it's either short there or no short there and long here to there. That doesn't do it. And once you're under here, then it's see you later. Potential to come out the bottom. Or not. We don't have to come out the bottom. But where's the stops from these longs who were aggressive? They're out. They're right under here. This is current low of the day. Now we can't say it'll take it out. All right. But possibility, right? So you put the trade on, you put your helmet on, and then it's subject to time frame and your trade management. Other than that, that's about it. Hold on 1 second. Gotta get this back here. Does that make sense, guys? Trading is time frame oriented. So I'm very much a Barker Lounger type trader. I put the trade on and I go for large rotations. It pays for the stops I take. The more I micro trade, the shorter rotations, the more active I am, and I'm getting the shorter rotation. What I found, I'm only talking about me, I'm not saying this is a good idea, I'm just saying it works for me, is my risk is pretty constant. So if I'm trading a large rotation, and I will take stops, I always do, not necessarily every day, but when things change, I'm a little slower to change. So I take my stops, but then I get on a large rotation that takes care of the stops, and hopefully by the end of the day, it's a profitable day. Other traders are putting similar risk on for shorter rotations. It's just a matter of edge and how you derive it. I'm not saying you can't derive better metrics than me. I'm not. My objectives are not going to be the same as yours. So that's just something to think about. So I don't trade all of these little rotations. I'm kind of, this market would have to really come back to take me out. So I will sit through these kinds of things. Other traders will not. This is a sweep. This suggests a counter rotation. So, and the outside edge of this is out in here. So this can come all the way out here. Now, subject to your trade plan, you might sell this to work on the stops that are under here. Notice this resting liquidity. If I know that the liquidity is there, unless they pull, if I get short, I have to be thinking about this. And then, of course, I am thinking about this too because of the statistics, but I cannot ignore this. So, trade management wise, this is something you individually have to determine, and which rotations. For example, some of us will not be able to handle mentally giving back this kind of rotation. Other traders are going to have their stop way out here, and they're going to stay out of this. They may perceive it as noise. So others are going to look at this and manage it much more tighter. And that's all up to you say. So you need to know that before the fact. The idea of Trader Lab is that you have a trade plan. The thing about it is, what do you want a trade plan for? Because you're not making it up here. If we accept the rotations are random, then we can't go, what do I do now? Should I get out? What should I do, right? Because nobody knows the answer to what it will do. We know what it might do. So the plan that you bring to the market already tells you, because you vetted it, what you will do, not what the market will do. So if you know what you will do, you will have a process for trade management, whether it's a trailing stop, you're doing it with some structure, you're throwing something over this that measures price, whether it's ATR or a trailing stop or some process that over time, not necessarily today, over time gives you an edge. So now we're coming back to the mid and the low volume node. The language of the market suggests this out here is too high. This is the retail price. And when you fall out, it is saying all of this might be too high. So then what happens here? Do we come all the way back across, or do we find resistance up in here? So this is the next question. We'll see what it does. How are you guys doing, by the way? Remember what trading is all about. Trading is really process and edge. After that, it's the rotations are random. And we have to get over, I believe, you got to get over this thing of being right and getting all of it. I've never figured out the thing about right is statistics in a random environment. The rotations, random. Can't figure that out. So then what? Hey, Tom, what's the benchmark for an account growth per year for a professional trader? The S&P does. I think that's, account growth in futures, I can't give you a benchmark because it's really subject to volatility. And, it depends. I think that depends on the time frame of the trader and the risk, So I don't think there's a flat answer for that. If we look at the S&P benchmark, futures are not related to that, A buy and hold strategy is not a trading strategy. It's an investment strategy. So I don't think we can compare them that way, I hope that's what, I'm not sure what you're asking me, but, if you're asking about buy and hold, then you just got to go with if you're doing buy and hold and you want to be in the basket, and I don't give advice, of course, on stocks or anything, but get an ETF and hang out with that. And then if you don't manage it, you're just going to be, rolling with it, or you can treat it, trade an ETF. You can use the auction to trade anything. This process is generic across all markets. Notice where we just came. This is the resistance, low volume node, okay? Which I was just mentioning to all of you. This is the outside edge. Why is it important? Because we've rejected the retail price. The volume has not caught up with it. But when you fall out of this, right there, that's resistance. So now, subject to your quote time frame, what is this? It's an outside edge. What is this? Buyers are here, sellers are here, micro volume, look to the right, you'll see it. Let me just show it to you. Ben, this is what you're asking me. This is your high volume. The sellers are here, the buyers are here. We break below, we test the price. This is mean reversion. This is a short if it's vetted. And then your goal is to get risk neutral, and then you're looking for this. Not a recommendation. And why might it be a short? Why? Why would you even think this, Tom? How could you make that statement? Well, let me show you why. And I'm not saying it's a short that anybody should take. I mean, it could be a short with a stop, too. Isn't that lovely? So let's look at this. This is your volume profile. Now, what is this volume profile? It's like, oh, give me an indicator that says green light, red light. Well, you actually have to think a little bit with this because you have to understand what's going on in the market. All of these are auctions. Every little one of these rotations is a consolidation, which is an auction, too high, too low. The high volumes are retail price, mini mart, and you leave it. Now, as we go down the food chain here, you'll see these rotations, too high, rotation, too high, rotation. This is inside of a developing daily time frame. So let's say I'm going down in time frame. Too high, too low, high volume. Now, this happens to be the highest volume for the day. And as I'm leaving these high volumes, they're saying it might be too high here. And you could go down into Bookmap and you'll see each one of these as they develop. It's the march of the wooden soldiers. You guys heard of that, right? Too high. And all of these are auctions. Well, when I break away from all of this, now this is the outside edge. We just came up to it. Now, if it's too high, I'm not paying that. Then what? Now we auction potentially this. Where's the retail price in here? It's right there. If I fall out of this, then I'm going to walk down the steps. When we went up, this is where the buyers were. Too low, too high, retail. Break away, too high, too low, retail. Too low, break away. Too high, too low, retail. Too low, break away. Too low, too high. You see what I'm saying? Now we go the other way. Too high, too low, retail. Too expensive, we're out of here. This can become resistance. And now we have retail here, support there, rotate. Now, any one of these can hold it, and then I can come back across the other way. I don't know. That's the auction. But now, let's remember what happened. The buyers have their sell stops under here. If you got long, and now you're back here, let me ask you, how's the Pepto-Bismol and Rolaids doing? How's your stomach lining? So if you're long, we know they have their stops under the low of the day. Now, there's not a high probability we take out the low of the day, except we've rejected yesterday's range. That's a biggie, and we've fallen out of that consolidation. We've gotten under here. We are below here. We're outside of the LVN, which was the last short, right? Let me come back and show it to you. 34, 24, I mean, there's the LVN, low volume node. We're not paying that. Now the buyers are out here. There was the sweep. That gave us the counter rotation. That sets up the short, and then it's risk neutral. We have to watch this here. We have a sweep. We can come back up again. And if we get back above here, we can come back here. If we can't get back above here, then we got that. I can't tell you which one. It's not my job. My job is to align. My job is to protect my account. My job is not to be concerned about being right. My job's to be following my plan in my time frame. I don't worry about being right. Never helped me in the past. In other words, my worry, my need to be right and get approval from the market. Unfortunately, this is not the place to get validation. This is a place to bring your business plan that has an edge and just execute. And if you have an edge, same as the casinos, even though they pay the gamblers, over time you're going to extract the dollars from the other participants. Now, what we know is sweep, counter rotation, sell trigger, sweep. We need to get below this, or else we're going to come back here, and then maybe back here. So this is what I know. So you're going to ask me, what do you know? This is what I know. I know maybe it'll do this, maybe it'll do that. Maybe when I get the sweep, it's going to come back here. Maybe if this low volume outside edge is too high, I'm going to rotate back here. And if I can't get back up here, then I know the possibility exists to come here. That's what I know. I know I have a sweep here, and the potential is for a counter rotation. I know if I don't get it, that helps me get to the stops for the buyers in this leg. The market goes down to go up and goes up to go down. Why does it do this? Good question. Why? Market goes down to go up. There's buy stops in here. The market goes up to go down. Why are we going down? Because there was buyers. The market goes down to go up. Why? Buy stops. And if I squeeze, and that's all this is, these rotations are fueled by the opposite side. So the sellers here have buy stops. You can see them coming out. Those are the buyers. The buyers in this leg have sell stops. And if we get below here, we got this. In fact, I got to label this. This is a variable high volume node. It's right here. So this is a potential target down here. This is the last area where it was too low. And our buyers took control right here. This is where everything changed on the short side. So the nature of the market, as you've observed, is to come back and check these prices. So this was too low. Okay, coming down, these levels were too high. So that was short, short, short. We were leaning on these for the shorts. Now, going in the opposite direction, look where this is. And look where this is. So that gives me a sense of possibilities to come under here and to come here. It's not a recommendation because who knows? And if I get under here and I absorb, now we don't know if they're going to trade. We don't know if they're going to pull. We know nothing. Okay. We want to watch the order flow and see if they press or this pulls. But if we do get under here, we want to see the behavior here. So for me, and it's a variable high volume node where the buyers took control, this would be an area of interest, not to get long, not, it might be the ultimate spot, but for trade management to get some scales, and then this. I get under here, then my target is going to be here. Not a recommendation. So that's a trade, so last trade, if that's in your plan, was short here. And this is structured trading. This is just using a profile in a very simple process. You can get much more sophisticated, if you will, with this. But in the stream, I'm just trying to keep it simple. Not take a lot of trades. Not show you that you can dance with this in shorter time frames. If you need to get the broad strokes down so you can anticipate locations and not be triggered with FOMO, try to reduce that response because we all have it. So when you understand in a higher time frame, and this is just a way to learn this, is you're not here to play a video game. There's going to be too much stimulus. When you understand, even if you're slow to turn the boat around, that there's change, then you can look ahead and go, well, where would a short be? It would be here. And you would learn, if you do the work in TraderLab, why this might be a short right here, and why this could be a short here. You would learn that because we're rejecting what was above, new retail price, shopping experience. When I go down in time frame, I got the same thing here against there. And now I'm below these sweeps. If I can't get back here, then I'm basically saying we're out of here and the longs now. So that's why this is a short, and subject to your plan, this is a short too. But let's use this one. And now you're going there. So what you're seeing, at least what I'm sharing in the stream, is not a lot of trades. It's not frequency of trading. I always want to come back to the idea of risk reward. Less trades, less risk. Same stops, less risk. If you take more trades, doesn't it make sense? You have more risk. Well, how about maybe less trades, same risk, higher rotation, more risk reward? You've got to find the balance. It's not percentage of winning trades. That's the wrong metric. You can have a low win rate and be very profitable because you're trading rotations. We are day traders. We're trading rotations. This is not a video game. No, I'm not saying it can't be for you, but if you're profitable, So would it make sense to you if you know the location and you have a triggering structure right here? Remember, location, there it is. It's sitting right there. So you would know with this sweep that it might come up here. And oh yeah, what else is here? The mid. How about that? And alignment. How about that? How about the trigger? How about that? How about a short? Up to you. There's also an entry here. But this is the spot. How would you be able to do this in a world of uncertainty? You would anticipate it. As I did here in the stream with you. I said, this is the area where we look. And there it goes there, bing, bing, there's the trigger, right, Ben? And that's the objective. Why? This is where the whole thing turned around. So what is the nature of the market? If I find too high, which was yesterday's low, failure to get inside that range, then what? Fade it. Then what? No longs. Or if you took a long, it's only reversion. Or you have no more longs and you're only using counter rotations to get short. Either one. All of them work as long as you have edge. For me, the first priority is to get risk neutral. After that, I'm indifferent to it because it's random. My job is to try to find locations where I know I have fuel on the opposite side. In other words, short. So if I'm getting long, I want shorts on the market because they're going to help me. If I want to get short here, I got longs in the market here. They're going to help me. I know I've got stops here. That's going to help me. And I know I've got a buyer here at a location. That might help me. So if I get short here, which is a structured trade, I've got to get risk neutral. My stop can stay out here. My next target would be here, ahead of it, right here. And then out the bottom, going for the ETH low. How many of these do you need? See? I hope that makes some sense. You guys, you have questions if you're in YouTube or TraderLab? If you do, or if you don't, come to TraderLab, guys. There's a link in the bottom of YouTube. Your questions get answered there. JEC, I hope I answered your question as far as I can't give you a portfolio growth as far as, I think if you have ETFs, that's basically, if you're an investor in day trading, the subject to one's skill, metrics, and all the other elements that make for consistent execution of edge, the yield can be substantially higher. The only limit to yield in the futures market really is edge and the ability to execute it. That's the way I look at it. I don't have any limit on other than myself and my capitalization, and my ability, to follow my plan. The issue for all traders is not profitability. I think it isn't. Profitability is the output of a vetted trade plan that has a statistical edge. The other aspect of that is the assumption is that a trader develops the discipline to actually execute it. It's no different than the casinos. They don't change the game. If the gamblers win, the casino will pay the gamblers. They don't now change the next hand how they play that game. They just do the same thing. We have emotional inputs that come into this that disrupt our edge and basically minimize or actually take an edge and throw it out the window. That will take us out of the business. To become detached from the outcome is very hard for us because of our primal wiring. I believe that's the biggest obstacle to this business. It's us. It's not the market. Certainly not the market. It's us. So we have to learn about us and the things we do that are self-defeating. And that is responding to our primal wiring, fight and flight, FOMO, fear of loss, looking for certainty, and all this other stuff where it doesn't exist. So where did we have our buyers? We had them here. So you might anticipate a reaction here. So for me, and it's not a recommendation, I sit through this, but I get risk neutral. It gets scaled. I have no risk on the trade after I get scaled. That's it. So that's it. Now, if it comes out here, takes this out, this trade would scratch. And I'm giving you the broad stroke. You could deploy a trade management process. That's something you have to vet. It is time frame specific. So some traders are going to use this structure right here. This is an auction. It's a consolidation. This price was too high. It's right there. You can see it. Let me show it to you. These are all things that you can isolate. And what it does is, if this is our short, I'm not paying that. Remember, this is language. Too high, too low, retail. This is reversion, microstructure. I always say the trade that every trader should develop, and I mean like the back of your hand, is something called mean reversion. Reversion is always returning to high price. Let's look at it again. Right there. You see that HVN, that's a high volume node. That is the mean in this little consolidation. Sellers, buyers, this is the mean, break low. It becomes resistance. There's the test. You see it? If I go down here, I have another one. Now, it doesn't mean it's the Rock of Gibraltar. It's only language. I don't use indicators. I am using the market language. Where does that come from? The participants. What do I know? I know this was too high, and I know this high volume right there was too high. So if I come back, they can act as resistance or not, Also, going up in time frame, what was this? Too low. And my buyers took over here. So my support is here and here in this high volume. Let me show you. There. So I got support here, break high, too low. Here, I had my buyers. I have stops under here. So I can rotate, and if it comes across here, I'm out. These can act as resistance. And the other part of this is there's buy stops above this leg. So every time I'm rotating, I'm going, I got sellers here, I got buyers on the other side of this. So we have to see what happens as we come back up. This is my outside edge. So I don't have to do anything here. If it comes up here, I would scratch the trade. My time frame, if this is my time frame. My time frame might be more active trade management or not. That's you. See, your time frame, not me. So let's watch. This is a buy sweep. Sell sweep, potential counter rotation. Sell sweep, potential not so much. Here, buy sweep, potential rotation down, still looking at this, or out. It's not more complicated than that. So right here, this is important. This is, what is this? Too high, too high. What is this? Rotation, stops, stops. Okay, where was too high? Here. Where's my sweep? Here. What now? Potential rotation. So, and if not, up. Now, let me ask you, if you're sitting short and you don't have a trade management process other than the whole structure fails, are you going to run out behind the garage, step on the rake a few times, or are you just going to take the next trade? See, this is where the thing about time frame comes in. And this is where every individual trader finds their groove. Some of you are going to go, I can't give this back. Well, maybe not. Other traders are going to be okay with it because they're just repositioned and they'll still go for statistics, which we have open below us. This is still open. So this is still a possibility. So we'll see what it does. Outside edge is up here. If it comes out here, the trade would be over and we could still be looking at it from out here if it just picks these guys off. Are you guys tracking? Any further questions here? We've got a couple of minutes left, and we do want to watch. Now this, remember, the idea is to go here. And if it comes back across here and squeezes these guys out, which looks like it will do, but I don't know if it will, this is still an outside area. And I'm not making any recommendations naturally. But I can tell you, if it comes out here, I'd still be looking at it. So, but what else do I know? I know I got buy stops here. So if I squeeze these guys out and I run out of buyers and I see absorption, this may sound a little foreign to you. If it doesn't change, I'd just be putting the trade back on again. And that's assuming I don't have any trade management. This is not what I would call a strong low on this rotation. Remember, I got resistance here. This is resistance also. So as I'm coming up, this is my outside edge. So I can pop into this, and if it's too high, I can just come right back around again. So I already know, unless something specifically changes, that I can take short still. And I have to always stress it's not a recommendation, because if it violates structure, then I'll just sit back and wait for clarity. I have specific trades, and in that 60 PDFs I've shared, you can see these, but you have to reverse engineer each one of them, you know? So let's watch it. Remember, too high, outside edge. Subject to time frame, you're either managing this reversal and then looking to put it out again, or you're going to sit through this, which is hard, right? Oh, I gave it all back. That's the mental state. And it has to fail for you to get out of it. And then you're just going to ride this. This is where a time frame comes in. And I know what happens is you want to be maybe trade for the larger rotation, but when you give back this MFE, it messes with you, mentally. Why didn't I? Well, I'm getting a question about Bitcoin if it follows the same logic. Yeah, it does. All markets behave the same way. Doesn't matter what you're trading. Any market, ETFs, stocks. This is how markets work. When you learn this process, you're actually learning how to trade. And you need to understand market mechanics, I believe, in order to get an edge over more indicator-based, conflicted, mechanical traders. For example, what would a mechanical trader do? Would they be short over here? Would they understand what this means here, and that we fell out? Would a mechanical trader know that we were targeting coming up yesterday's low and the statistics to get there? And what would happen if we got into yesterday's range? Well, and also why it was material that we didn't, and then that you would turn around and primarily think shorts or counter rotation longs if you trade those. At the moment, I don't have any longs, and that doesn't mean the market won't take out the high of the day. That's not my job. My job is alignment. So at the moment, and notice these guys pulled. That's good information, don't you think? What does that do for my short? Well, I don't know if they're going to come back in, and this is just kind of like, come here. It's like, come over here. But when they pull, if they don't come back in, then the longs who are sitting under here with their sell stops, that's what I'm trading into. The market goes up to go down. The market goes down to go up. And yes, you can use auction market theory to trade anything. How you guys doing? How we doing in YouTube? Hope you're getting something out of this. Please give a like. This is Trader Lab. There's a link in the bottom of YouTube if you're interested in this method. This is not the epitome of trading by any means, and I'm only sharing broad strokes. The Traders in Trader Lab, it's a community of like-minded traders. It doesn't matter how long you've been trading or what you're doing. Most traders who are in Trader Lab are in this because they're in this to create careers. They want to understand better how to navigate a random environment, deal with the psychological aspects, and build out plans that give them a statistical edge. This is not a predictable business in the sense of predictability. You're in a random environment. Anything can happen anytime. A tweet, right? A geopolitical event, anything, right? So you're always in randomness. So over a large sample size in a random environment, same as the casinos, you have to operate with a plan that you already know that you bring to the random environment that has a statistical edge. Then it's whatever, right? So why would I be taking shorts here? Well, you would understand this if you're in Trader Lab. Why would I understand that my resistance is here? Because my sellers were here. If I come up, what does that do for me? Well, I can sell it again. This is another short, or I'm just sitting. Why? My time frame. Where am I trying to go? Well, this thing called risk reward. If I get under here, and what is my probability of getting to the ETH high or low? And I don't notice us taking out the ETH high, do you? There's a 91% probability. Taking the ETH low has a 72% probability. Why wouldn't I put a trade on short from here to go there? You see? Is that a good risk reward ratio with about a 3-point stop, trading more than one contract naturally, getting risk neutral. So the worst that happens is I scratch and then I, hold on to my, actually it was here, wasn't it? Can't remember. I think of the short was here, sit through this, want to lose your lunch, or trade management, put it back out, or scaling, risk neutral, put another basket on of whatever positions, scale again, and now you're running X number of contracts, looking to scale ahead of this or this, still another scale here because this is where the reversal started. So that was too low. What does the market tend to do? Come back and check. This is shopping. It was too low. Wow. If this is too high, let's go back, Bertha, and let's check what was too low. Next target and then there. Not a recommendation. That's the trade. Now, it might not be your thing. Might not even be my thing. But it is a thing. It's called something. And you can learn something if you come to Trader Lab. And there's a link in the bottom of YouTube. By the way, there's no cost for this. You don't have to be a Bookmap subscriber. You won't be solicited, harassed, or otherwise abused. The only thing you need to know is Trader Lab's for serious traders. It's not romper room. Our senior trader has over 50 years trading experience. I've been doing this 46, going on 47 years, both as a professional and also out here with you. So there's no magic. There's no quick fix. There's none of that. So we have to get over that. And we all have random winning trades. And the problem with winning trades is, you would think that's not the problem, but it is, because gamblers have winning hands, but they don't, over time, leave the casino with the dollars. The casino is the one who gets the dollars. It's just a random distribution of outcomes. We all have winning trades. The difference is your account leaking equity in spite of the winners? Then you don't have an edge. And you're trying to get more consistency, I understand, and more winners, of course. But if you don't have statistical probabilities and know where your trades are, in that you have an edge. And if you're just making it up as you go, then you're sitting with the gamblers, and that might be fun, it might be entertainment, but it's probably not sustainable. If you're interested in a career path, and of course, past performance is never indicative of future results, use the link in the bottom of YouTube. There's no cost for Trader Lab, and maybe in your journey, you can maybe change your outcome and stop waking up in the same place, no matter how hard you try. I coined a term for myself doing that. It was called Trader Groundhog Day, working hard, waking up in the same place. If that's you, it isn't your effort. It might be you're trying to fix a process that might not be in alignment with what the business actually is. Please give a like on the way out. Thanks for visiting Trader Lab today, and I look forward to seeing you guys soon. And if you're in Trader Lab, guys, this stream is available to you for review. You might want to take a look, do your screenshots, annotate, and keep building your deck of trades. Take care, guys. Thanks again. And thanks for visiting Trader Lab today. And don't forget the like on the way out.